Hello friends, the fact that you're watching this video tells me that you are a trader, possibly with exposure in options and futures. You want to maximize your gains, reduce your losses, and stay on the right side of the market. Well, in this video, I've just got the perfect tools for you to understand the game better. Now, the first things first, you should know is whether to buy or to sell options, whether to buy futures or to short futures. Where is there bigger money, in buying or in selling? And more importantly, why? Once you know the cause, you know the effect. Knowing your game gives you a direct advantage over the others. Now, the one thing is the direction. Should you be buying at that particular point in time or should you be selling? But that's just one aspect of it all. The other aspect is when you're trading an instrument, like say an option or a future, how is that instrument structured? Is it structured to favor bulls, which is the buyer of an option, or is it structured to favor a writer of an option or a seller of an option? And like I said, you need to understand why. Now, if you understand your financial market history, you will realize that there have been panics, there have been crashes, there have been precipitous declines in the markets, and big investors have been requested by the administrations, by the powers that be, to come and rescue the market. And these Mr. Moneybags, the richy rich guys, have come, invested a lot of money in stocks at very low prices and made tons and tons of money. But do you know that in addition to capital appreciation and profit on the shares that they bought, these financiers also insisted on receiving interest on their investment that they made into the markets. And over a period of time, the markets were built to reward a financer or a money lender who invested his money and put it at risk as compared to somebody who was a borrower of money, which in this case is a leveraged buyer, and therefore he was made to pay interest. Now imagine you are a buyer and this guy is a seller. You buy something at 100 and you pay 2 rupees interest per month. At the end of the year, your cost will be 124 rupees. Whereas this guy would have earned 24 rupees by way of interest, not taking any risk at all because the trade would be guaranteed by the exchange. Now, this is the 24 rupee advantage that the seller has over the buyer. Now, when you're paying interest, you're working for the financer. That is rule number one. Now, you need to understand whether the markets rise faster or they fall faster. There is an old saying in Wall Street, the markets climb up through the staircase, but they fall down via the elevator shaft, which means the fall is invariably much more faster than the rally. Which means when the rise is slow and prolonged, a buyer will continue to pay interest to the seller, and if the rate of climb is 3 to 4 times slower than the rate of decline, it takes 4 times more for the stock to go up as compared to the stock coming down. Don't forget the way certain PSUs and many other private sector stocks fell on 4th of June 2024. I saw declines intraday of 25% on a couple of stocks, and 20% and above was something many stocks recorded declines of. So you know that markets dive much more faster than they rise. Why is that? When stocks are climbing, they have to fight 3 forces. Number one, the limitation of capital of the bulls, because capital is a limited and a finite asset. Number two, they have to, when they are going up, they have to fight the supply coming in from sellers. And number three, force of gravity. For those who think stocks are inanimate objects and are not subject to gravity, Please Google search the center of gravity oscillator. You will know what I'm talking about. Whereas falling markets, on the other hand, when bulls have stopped buying, they are tired. Bears start to short prices. So gravity pulls these prices faster. There's limitation of financial resources with the bulls, and therefore the declines are much more faster. Now, you fuse the two theories together. A buyer is paying interest, a seller is receiving interest. Markets take 3 to 4 times longer to rise and one third to one fourth of the time to fall. Do you know who makes more money now? It's the option writer, the option seller. Options were ushered in by the Chicago Board of Options Exchange, CBOE, and luckily for us, they have computerized records since day one on options trading. You'll be surprised to note that 88%, approximately 88% of all options buyers witness their option trades close out at the expiry in losses. What does that tell you? Since markets are a zero sum game, the losses of 88% go to 12% of the winners, who are the option sellers or option writers. Now, that's the kind of disproportionate profit that option writers, and to that extent also futures short sellers, earn, because short selling also gets you rollover costs, or Vyaj Badla as it was known in the olden days. Now that we are talking about Vyaj Badla, let me tell you my experience, and I have been trading these markets since 1986. Vyaj Badla was a system of contango in the Indian domesticated format. Now, interest cost was levied every fortnight, and interest rates were negotiated online just like you bought and sold stocks. You will be surprised to know the interest rate prevalent was 2%. Remember, per fortnight, which is 4% per month. How much money do you think a buyer or a bull could make at the end of the year if he had to pay 48% interest on his long positions? Would I even want to take risk with my money when I'm getting 48% as a money lender in the Vyaj Badla market, where I received shares as collateral and the trade was guaranteed by the recognized stock exchange? Not at all. Give me 45%, 48% per annum risk free. I'll retire. All right. So, this is the kind of unfair advantage that the markets have been built into, with interest charges being levied on the buyer. This is thanks to guys like JP Morgan, Baron Rothschilds, and many such Mr. Moneybags who've rescued markets at times of extreme distress. Now that you understand that the table in the casino is tilted, when you throw the dice, it's going to favor a certain type of player only. Now imagine why option sellers are charged span margin and concentration and extreme loss margins, and option buyers are not charged any margin whatsoever. They only pay a premium. Why is that? It is so that guys are lulled into thinking, hey, it's only 3,000 rupees. At the most, I will lose this premium fully, and it will only be 3,000 rupees because your maximum loss is equal to your premium. What you are doing is providing interest to a savvy moneylender who is writing that option, and that 3,000 rupees could be constituting far above bank FD rates of interest that he has just collected from you, which is why option buyers are not charged any span or a mark to market margin, or even concentration and extreme loss margins. So now you know why you're told that your only loss will be the premium that you have paid. What you're conveniently not told is that your odds of success are only 12% because 88% of option buyers are going to witness the price go to zilch on expiry. Hey, making money was never really easy. Now, most of what I have told you so far is theory. Is there an actionable blueprint here? Yes, there is. Take a stock, any stock that has gone up 300, 400% in about a year's time, maybe a little more, but it's gone up significantly. Now, if you look at many stocks, they have multiplied in the last year or year and a half. If they are in the futures and options segment, what you do is calculate how much MWPL or market wide position limits the stock is commanding. Now, market wide position limits are exposure levels that are utilized by traders as a total component of exposure allowed by SEBI. Therefore, what I'm trying to gauge is the financial and emotional commitment made by these traders in these particular counters. If the MWPL is very high and the stock has run up significantly, what happens when a short seller shorts the counter in the future and collects cost of carry month after month, month after month? You will realize that the rate of return of a long bull, a person who has bought this stock, will actually be negligible or even be negative adjusted for the interest. And over a period of time, the guy who has shorted the future will keep collecting the rollover costs, and his short selling cost will continue to rise month after month. But is that it, or is there more? I think there is more, and let me share that little secret with you. Now, what if you were to sell a counter at 300 rupees? The figure is hypothetical. Let's not take any names. Those who know will know. Supposing this counter has risen 350 to 400% in the last 1 year or so, and it is currently quoting at 300. You go out there and take a look at how much MWPL there is. If the MWPL has risen, say 50, 60, 70% of what it used to be when the price was lower, you know that a whole lot of emotional and financial commitment has increased in that particular counter, which makes this counter very volatile, because whenever the tide turns and negative news or a marginal selling comes in, there will be a crowded exit in this counter. So what you do is you short sell the future with the intention of collecting a premium, and your short price is 300. At the same time, what you do is write or sell a put option at a strike price of 250. What have you done? You are basically betting that the price will not fall below 250 minus the premium that you have collected. Now, let us assume that your futures rollover month after month will get you 2 rupees premium. Market lot is 5,000 shares. So every month you will receive 10,000 rupees by way of premium collected on the futures rollover. Now, 250 rupee put option writing gives you a premium of 3 rupees. You will start to lose money on the options trade, which you have shorted the puts at 250 at a premium of 3 rupees, only if the price falls below 247. But that's just the option leg. In the futures leg, you would be in the money because you have shorted the future at 300 money. And because options premium erodes or decays over a period of time, by the time the price comes down, the premium would still remain probably where you sold it at. So you could get out at break even and collect a big fat profit on your futures. Now, there is more. Because you shorted or wrote a put option, that is an indirect way of going long, and you were short in the futures segment, The exchange says, hey, you are long and short both, so you're delta hedged. You don't provide us or present us with as much risk as a naked futures seller. So what we are going to do is give you a discount in the span margin that we are going to charge you. So what have you done? You've earned 2 rupees rollover costs on future, you've earned 3 rupees as put option writing premium, and you've paid less margin than the other guy. So you're getting a bigger bang for the buck. Now you see how the market is tilted in favor of financiers, money lenders, and interest collectors. I love this game because I believe in writing more options than buying them. Let the other guy go out there and pay me premium while I take the premium and put it in my pocket. Now, guys who buy options are basically seeing their profits eroded and eaten up by these interest costs that they keep paying month after month for going long. Options premium depends on a variety of factors. The RFR or the risk free rate is one of them. Now, what is the risk free rate? The yield on Indian 10-year benchmark bond. Now, the yield is approximately 7%, which is higher than many countries in the Western part of the world, which is why options premium is invariably higher in India as a percentage on capital invested as compared to a whole lot of other countries. Now you know that there are many high frequency traders, algo traders, artificial intelligence based hedge fund traders who are coming into the country to set up shop here to trade in derivatives. What do you think they are going to do? They are getting mouth-watering returns by way of options writing and pocketing that premium, just like I told you, a savvy investor would do. You're going to have the smartest people in the world with shiploads of money coming in from Western nations and writing options. And if at that point in time you're going to be the sacrificial goat buying these options, you're only going to pay them interest because these guys are interest collectors. Now, off late, especially before the election results were out, I used to hear or read rather on social media a lot of interesting and I also found it funny. A lot of comments from people who wouldn't know otherwise because they don't seem to be real world traders like you and me. Now, they were commenting on how the FIIs were short by XYZ number of contracts in the futures, in the indices, and XYZ number of futures lots in stocks. What they were not telling you was, or they could not know themselves, not being traders, if an FII has sold something at 300 rupees and rolled over that position for 6 months, assuming a rollover cost of 2 rupees, in 6 months the FII would have got 12 rupees by way of interest. So if at all that FII is squaring up that short position at 305 after having sold at 300, you and I think that it's a loss of 5 rupees. How much they've collected by way of rollover costs, you don't know. And in the interim, how many times they've written more and more delta hedged options and collected that premium and pocketed the same that they haven't told you, and you couldn't be any wiser. So you see, nothing happens in the financial markets without a reason, and because these are financial markets, the reason is also financial. And WYSIWYG, what you see is what you get, is a myth in financial markets. You are made to see something, but it need not be the truth. Let's be careful out there and let's stay ahead of the crowds with a 360-degree worldview of the markets. That's what you and me do as real world traders. Friends, if you want any more videos on options, futures, trading strategies, and a whole lot of other ideas that we real world traders discuss amongst ourselves, please let me know in the comment segment. I would be happy to oblige. Before I sign out from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know what you think about my work. I would request you to share my video with smart and savvy traders like yourself so I can reach out to a whole lot of other traders like yourselves. Thank you for your patience in being with me in this video. Till we meet again, this is Vijay Bhambwani signing off for now. Wish you have a very, very profitable day ahead. Bye-bye.